Joining us now to offer insight on these and other trends is market analyst Shawn Hackett. Shawn, welcome back.
Thanks.
Shawn, I want to start out here talking about the wheat market. We saw July KC put in a new low. Minneapolis and Chicago were not far behind, if maybe did touch some of those contract lows. How much lower can we go?
Well, I mean, we're kind of doing the pre-harvest pressure that you typically see. A lot of farmers sell wheat right off the field. They don't store it. Right now, the gradings are way up from last year, and so everyone's expecting a big crop. Of course, weather's still in vogue. There still can be there's a lot of excessive moisture coming in for Oklahoma, for example, and Kansas, and that may still create some problems. But right now, the market's saying big crop, harvest coming, pressure. We got to find a bottom for this place, and so this is kind of typical pre-harvest action. Probably not a whole lot more to go where we are now, but probably not a whole lot of reason to rise unless Mother Nature gets involved here in May.
So what are you expecting to see for a range if we're not going to maybe head much lower, but we're also not going to gain much?
I think $4 on a KC wheat, for example, is probably your low. It was the low that we hit last year. When we look at relative value, of KC wheat to all other commodities. It's right now trading at the third cheapest level in 50 years. So we're at levels where we really don't have a lot of examples of wheat getting much cheaper. But at the same time, that's a longer term forecast. It doesn't mean that we have to rocket higher. But I would say this rally could rally 20 or 30 cents just because of short covering, that sort of thing right now.
Okay, let's talk about short covering going on in the corn market right now. We saw some strength on Thursday. Was that because the funds are finally starting to maybe sell out of some of those short positions?
Well, I mean, certainly that's happening a little bit. We never know why they buy or why they sell because the algorithm is sort of secret, right? But certainly, as we get into this weather scenario that we've been dealing with, in April, fine, we can catch up, no worries, but we're continuing to see excessive moisture, snow in the northern belt, and for the next 2 weeks at least into mid-May, and we're just not going to catch up the way it looks over the next couple of weeks. And I would say some of the funds have to have in their algorithm some point where they say this could be a problem, we need to start covering. That might have happened on Thursday when we had that reversal, 350 or 351 July corn, and then we rallied right off the lows. I think weather's starting to finally maybe play into the psychology of the corn market at least.
How much can we really gain from the weather market, though? Because, Shawn, as we know, farmers can get into the field. They can probably plant a week and a half if they have really good dry weather with the technology and the equipment we have. So do we have that much more of a weather premium to build in?
I think we do if we get into mid-May and we're still way behind. I mean, the University of Illinois said 2 weeks, if you have good weather and everyone rocks and rolls, that you can get the crop planted in the main corn states. And so if we get into mid-May and we're still way behind and we're still not seeing any big windows to open up, I mean, I think there's definitely more weather premium to put in. I mean, it wouldn't surprise me if another 10 or 20 cents could put into the corn market if we get in to mid-May and we're really not catching up much. And I don't think we are. I mean, it looks really bad right now.
It does. And maybe we'll see some differences on this next week's planting progress report. Is weather the reason you mentioned in your newsletter this week that you believe smart money is moving closer to a buy signal?
We never know why smart money or insiders do what they do, but we can speculate. I mean, I would speculate that probably the weather's starting to make the smart money consider buying. Just the fact that we're getting so low in many markets, that the economics are so good that they can't help themselves but buy some. And I do think as much as we keep thinking about the trade deal and it's not happening or no, but maybe they know something we don't know. Maybe they know it actually is going to finally come to fruition, and because they've gotten really aggressive here in the last 2 weeks when they really have not. So maybe they know something we don't, and I'm hopeful they're right.
Okay. I think that poses the question. This is a question I get from producers a lot, and quite a few producers wrote in and asked essentially this question. We've got one here from Matt in Amherst, Wisconsin. He said, is it okay to throw the seasonal trends charts out yet for all grain commodities?
I would say no, it's not time yet to throw the seasonal trends out, but sometimes seasonal trends are abided by and sometimes they're not. I mean, that's an average. Right now, we've obviously not been following seasonal trends and in
any of the grain commodities.
Right? I mean, we really haven't. I mean, we've been kind of doing everything opposite of what you would expect to see. And there's so much going on that's caused that: strong dollar, trade problems, and just it's just been a confluence of things. But I don't think we can say that the seasonal pattern is dead yet. But certainly we're not following it. So there's a possibility that if we don't rally now, we might rally counter seasonally later in the season. So we have to be ready for that.
So let's talk about the beans and what's going on with the Chinese trade deal. Of course, as you mentioned, maybe the funds know something that we don't. But Shawn, if we get a trade deal in place, we still have a really large global stockpile. So does the U.S.-Chinese trade deal change anything for the futures long term?
It depends on the details, right? I mean, we hear all these rumors about how much they're going to buy. They're going to buy 30%, half the soybeans we have. The reality is, given what we see with the planting weather, maybe gaining an extra 1 million or 2 million acres of soybeans, or looking at a 1 billion bushel carryout, it would seem a trade deal wouldn't be enough to rid ourselves of our bearish fundamentals. We would need a weather problem in August to do that. And so any rally that we would get on a trade deal, should we get it, probably should be sold. That's the way it looks to us right now. It's really hard to see how they would buy that many soybeans from us and remove this bearish overhang. But it could create a short-term, short-covering rally if we were to get it.
Shawn, final question for you when we talk about beans, because we definitely have a lot to talk about in the livestock and dairy markets. The path of least resistance seems to be down for the bean contracts. I mean, July put in a new contract low this week. How much lower is that path?
We have clear support, in the low 8s, really. I mean, that's kind of where we were, if you remember, at harvest time, and then we got excited about trade and the market moved higher, and we've been sort of holding the line, and now everyone's just getting so frustrated and they're finally just giving up, like this is not going to happen, and we're seeing more acres possibly coming in, and so we're just pushing this market down. But there's more downside here. Short term, if there's no trade resolving, low 8s is on the docket. I mean, the chart pattern is pretty clear on this.
Okay, let's talk about the charts when we look at the cattle market. Let's start with the live cattle market. The chart, you look at it and it's a drastic drop here over Thursday and Friday. Wednesday had some rough closes. What's going on there?
I mean, the African swine fever is driving the live stock markets crazy. I mean, we see with hogs, limit up, limit up, limit down, and they were, so the cattle market has gotten some headwinds, not only from some really nasty weather this winter, but also from speculators coming in and buying the market, thinking that African swine fever is going to create substitution demand for beef, and it is. But the devil's in the timing and the details. And once the hog report came out that we didn't really sell a lot of hogs this week and they went down, limit down, then the speculators just kind of caved in and sold that market really, really hard. And with the deluge going on everywhere else, it's pretty hard for the long speculator to say, I'm going to stay in here when everything else is falling apart around us. The dollar made new rally highs. It was just a time for them to just kind of get out and really exit the market. And when they do it fast and furious. The computers don't hold back.
So were the closes this week just a short-term correction, or do you think that now the trend is to continue heading down?
I don't think it's that way for cattle. I mean, cattle had some of the African swine fever in it, but there's a lot of non-Chinese reasons for the market to hold itself in here and kind of develop a base. I have a hard time feeling that the hog market is at a bottom yet. I still think we can correct that market. There's been a lot of speculation, and there's a lot of trade-related speculation that's gone on there, and we just don't think that that market's done ridding itself of some of the excess that was in there. We think that could come down lower, but we don't think it brings the cattle market much lower. We think the cattle market digs its heels in ahead of the grilling season, when we normally have really, really good underlying demand for domestic demand for beef.
So how much lower can the lean hog markets go then, if you say maybe we're not done correcting that move yet?
I think we could go down another 5 points down, maybe another limit down day or something like that, and maybe a little more follow through. We think that's very, very possible. And then we would come to some kind of chart support that we had last time before we had that big surge back up. So I think there's a pretty solid base 5 to 8 lower in this market that we could hit. Could be next week if the Chinese don't buy again. We could certainly, continue that momentum downward.
And is Chinese buying, is that really what we need to see more strength or continued strength, maybe a reversal back towards a higher trend?
That's what's been driving it. When we didn't see it before, the market crashed. Then we saw it, the market took off. Then we didn't see it, the market crashed. So right now we are trading the weekly export report, and I think we're going to continue to trade that unless we get a trade deal that says they are going to buy a lot and regularly.
Yes. Which is what I'm sure a lot of producers are hoping for.
Yes.
The bright spot this week, which hasn't had a bright spot maybe in quite some time, was the dairy markets. Thursday's closes were spectacular. We put 62 cents on the week from last week. Shawn, what's going on there?
Well, our production is finally coming to wraps. We've been at 0.5% growth or less for the last 5 or 6 months. In fact, we had a negative production report. Anyone knows U.S. dairy, we almost never go negative. I mean, it's almost impossible to get the U.S. producers to go negative on production, but we did do that. We had to go back to February of 2017 for the last time we had a negative report. And so with that kind of production, we're seeing cheese stocks relative to last year starting to narrow in terms of the year-over-year difference. And we can see that we're going to be in a position of drawing down these very large cheese stocks pretty substantially if we keep this production down in this 0.5% growth or less, which we think we will. And we have international prices for GDT prices up 30 to 50% over the last 6 months, and we usually lag them but then catch up. So there's a lot of reasons to think that this rally has legs to it, and milk prices tend to trade differently than the grains and differently than the other livestock markets. It's kind of on a different cycle, a different phase. It goes up when everything else is not, and so it's a perfect time for the market to rally. So we like this market still feel that farmers are on the mend and will have a chance to sell finally some prices that work for them later on in the summer.
We're approaching high 16s, maybe low 17s in some of the deferred contracts. How much higher can some of those dairy producers expect?
I mean, I think right now, based upon what we see with everything, we think we can see solid mid-17s, maybe even 18, and let's say in the deferred contracts when supplies are tighter. We think it's going to be very hard to do much better than that unless we get some help from a trade deal, some help with a weaker dollar, which has been hurting exports. But we think with what we have in place right now, there's a clear path to the mid-17s or 18s, and that would be, a pretty good place to probably start putting some sales on, or at least buying some puts to lay a floor into the market.
You mentioned trade deals. Just really quickly, Shawn, does the U.S.-China trade deal, does that add any support to the dairy markets? It
can, look, they've always been a big buyer of dry whey. What we're hopeful that they might be a big buyer of is non-fat dairy. And what we're also hopeful they might be a buyer of is U.S. cheese. We know they went from buying no cheese 5 or 6 years ago to being one of the largest cheese importers in the world. And so if they were to come and start buying our cheese, it could have a big impact. But of course, the devil's in the details.
Right, of course. Shawn Hackett will continue this discussion in Market Plus. Thank you so much.
Thank you.
That wraps up the broadcast portion, but as mentioned, we're going to continue this conversation on Market Plus, where we'll answer more of your questions. You can find it on our website at markettomarket.org. As some of you begin spring fieldwork, others are relegated to just looking at images via Instagram. We've already posted a few of our own. Take a look at IPTV Market. Join us again next week when we look at another battle brewing over water, this time in the Heartland. So until then, thanks for watching. I'm Delaney Howell. Have a great week.